This Beige Book, released just today, is overall more negative than everything that we saw in July. Most of the 12 Federal Reserve districts reported little or no change in economic activity overall. Most notably, real wage growth seems to be dismal, and it's weighing on consumer spending and consumer activity. Focusing on those wages and the labor market that's producing those wages, 11 of the 12 Federal Reserve districts describe little or no net change in overall employment levels, corroborating basically what we've seen in the payrolls over the last several months. Looking at prices, a little bit more inflationary than everything we saw in July. 10 of the 12 districts characterize price growth as moderate or modest. The other two districts, strong input price growth that's outpacing moderate or modest selling prices. And that's going to be the thing that we're going to be thinking about with the inflation landscape going forward. There are some tariff price pressures that are going into the pipeline, and the question is just how much can consumers allow those prices to rise before demand retrenches. And the Beige Book right now is showing that demand is retrenching because of weakening real wages.
On that, Stuart, reading from the Beige Book, it says, quote, contacts frequently cited economic uncertainty and tariffs as negative factors. New York reported that, quote, consumers were being squeezed by rising costs of insurance, utilities, and other expenses. The Beige Book also noting that contacts reported flat to declining consumer spending because for many households, wages were failing to keep up with rising prices. What does all of this mean for the Fed meeting later this month and that 25 basis point cut that pretty much everyone out there is expecting?
Everyone's expecting it, but what this really ends up coming down to is counting the votes on the FOMC on that monetary policy making committee. So one of the things that's nice about the Beige Book, we get to look at activity in each of the Federal Reserve districts. I think for September, the most important district is Kansas City. Jeffrey Schmid, a voter, president of the Federal Reserve Bank of Kansas City. Right now, we're seeing that economic activity was generally flat. Employment declined modestly. Wage pressures remained subdued. All of those factors might mean that one of the most hawkish voters on the committee could be a little bit more open to the idea of voting for a cut. You could see that true coalition building around exactly what Governor Waller wants, what San Francisco Fed President Daly has said she's wide open to, and that's a cut at this upcoming meeting.
Are you saying because he's been so hawkish and then he's seeing moderate activity, that's why this is an interesting Fed governor to focus on?
That's exactly right. He is, by our natural language processing tools, the most hawkish member of the committee. He is a voter, and conditions locally are weak. Conditions locally likely warrant a cut in his eyes.
Do conditions locally inform the way that voting members of the Federal Reserve who represent certain districts will vote? Is that their responsibility? Is that their job to represent their districts?
It's not specifically enumerated in the Federal Reserve Act that they must set policy according to conditions locally, but the reason why the districts are divided up the way they are is so that everybody around the country has someone who is representing their interests. And similarly, there are requirements on the Board of Governors that the composition of the governors are supposed to represent conditions around the country. So these are important qualitative aspects of local conditions that feed into the decision-making process. Do we know for certain how any one person is going to vote? No, certainly not. But when we see conditions cooling in a district that is presided over by one of the more hawkish members, you would think they might start pivoting a little bit more dovish, and we can see that coalition building around a cut in September.
Let's not forget, we get some inflation prints before the next Fed decision. We get the monthly jobs report on Friday. There's a lot that still could come to the Fed that could impact their decision. The other thing, though, and let me just roll this into it, Stuart, this possible legal rollback of tariffs, which could be, this is a major uncertainty. I know the president said yesterday some urgency to make this decision, like, let's figure this out sooner rather than later. Is the Fed going to err on the side of holding off on any kind of move because there is still some uncertainty? Are there enough evidence or a growing number of evidence that the economy is slowing that it does make sense to cut rates of some sort?
I think that there is enough evidence that's been accumulated when you look across the broad swath of indicators, whether it's real wage growth, whether it's the pace of hiring, whether it's some of the anecdotal data that we're getting just today, that a cut is warranted. The question is whether they want to do it in September or whether they want to do it a little bit further down the line. From an economic perspective, it doesn't matter that much. They could wait until December if they wanted to. They could wait until 2016 if they wanted to. But it looks like the coalition probably is there based on the data that we're seeing, based on the anecdotes that we're seeing, to deliver a cut in September.
Stephen Myron, right? We've got a hearing tomorrow. President Trump is very eager to get him in place on the Fed board. How might that change some of the composition and change all of the discussions that happen around the table at the Fed?
You know that you'd get another voice that's advocating for a cut. And I expect that he will be confirmed in time to vote on the 17th. And again, it's just part of that coalition that's building.